Welcome from me, Guy Monson, to Sarasin's 6-Minute Strategy. Today, Subitha and I will be discussing the tectonic shifts underway in Washington and their potential impact on financial markets. Following President Trump's decisive victory last Tuesday, we've seen a strong response from equities. The S&P 500 is up by 3.7%, global equities by 2.4%, while US small-cap stocks have climbed by an impressive 6%. Meanwhile, Chinese equities declined, as expected, but only by a modest 1.3%. So how sustainable is this US-centric rally looking forward? The answer, we believe, will depend largely on the trajectory of US bond yields. Immediately after the election, yields spiked. They've since returned to around 4.3%, essentially where they were on election night. Against this backdrop, Trump's policy agenda, tax cuts, raising tariffs and tightening immigration, all come with challenges. Each of these measures could lead to either an increased government deficit, higher inflation, or both, a potentially problematic combination for today's overburdened bond markets. In the following slides, Subitha and I will explore these policies in more detail. We'll look at their potential scale and timing, and the implications they have for your portfolios in the slides ahead. So welcome, Subitha, back to 6-Minute Strategy. Gosh, we need you to analyse these tectonic political shifts in Washington over the last few days. But before we get there, let me just update our viewers quickly on markets for the year to date. The dollar in that left-hand panel in blue, they're up 4%, rose strongly after the Trump victory. Oil actually, if anything, modestly down for the year, down about 2%. And US 10-year bond yields up at 4.30, a rise for the year. But interestingly, the yields spiked up on the immediate Trump victory and then settled back to where they'd started. On the right-hand side, the real action, global equities led by the US up 3.7% and small cap up an extraordinary 6%, as people bet on a deregulatory, corporate-friendly backdrop from Trump's policy announcements to date. But let's dig a lot deeper into this. This was a strong mandate, wasn't it, for Trump?
Yes, I mean, I think what was remarkable is President Trump not only won the electoral colleges, but he also won the popular vote, which has been the first time a Republican president has won it in 20 years. They have both houses of Congress and actually a slightly larger majority than most people had predicted in the Senate. So it is really a strong mandate for President Trump to deliver on the campaign promises. This is a vision of the US as a very pro-business economy, really cementing its advantage as a low tax, low regulation, and really low energy cost economy relative to its trading partners.
It's an exciting in some ways story, daunting in others, but let's begin with tariffs and trade. And what are your key worries over the tariff proposals?
So I think one of the key tenets of President Trump has been quite dominant throughout his tenure, even as the first president, which is a vision that the US has been unfairly treated by its trading partners. I think he would like to extract greater concessions from all other trading partners. The US today is the world's largest consumer economy, and they'd like to extract greater benefits for providing producers elsewhere access to the US market. The US is also a leading producer of technology and defense, and they'd like to extract greater concessions to provide other economies US IP.
So he wants concessions both as a consumer and as a supplier.
And I think the tool to do that really is quite blunt. It's just high tariffs across the board. So the proposals are a 60% tariff on China, a 10 to 20% tariff on all trading partners, or a reciprocal tariff arrangement where US tariffs will basically be the same as what its trading partner has on the table currently. So it's a big departure from the laissez-faire globalized world that we have come to live in. And it's really much more akin to more mercantilist policies of the 17th and 18th centuries.
Tell me, tax cuts. He's going to extend the TCJA, I understand. What do you think else we'll see in his policy pocket?
So the individual mandates, which is just, the tax cuts we got in at the end of 2017, those he would like to extend further. But I think there's also a proposal on the table to cut corporate taxes, which are roughly 21% today for US businesses. And I think there have been a number of iterations of this, but I think what's clear is that they would like US businesses that produce domestically to enjoy a tax advantage, so somewhere in the 15 to 18% range. There are proposals as well to give give 100% bonus depreciations for investment. And these would include research and other costs as well.
And take us on to deregulation, the other pillar of his policy settings.
So deregulation is, on the face of it, it's basically restructuring the size of the role of the government in society. So there's a proposal, obviously, to be led by Elon Musk, who's going to set up a Department of Government Efficiency, which
Doge, as he likes to call it,
yes,
after the crypto. Yeah.
And that is seeking to put in place about $2 trillion in spending reductions, which would be an enormous amount of efficiency if delivered. There is a proposal to turn a large portion of the federal government employees onto Schedule F, which would take away their employment rights and allow the government to restructure the size of the government.
So really a radical view, even for the inside the engine of Washington and across the whole federal administration.
Yes, and I think really the deregulation is aimed at two sectors broadly, which are energy and financials. So they would like to reduce, obviously, the constraints on oil and gas drilling, but also be much more friendly towards mergers and acquisitions, and also allow consolidation in the financial sector.
So we can see the opportunities here. We can see the deregulation, we can see the pro-business agenda. The risks seem to me come in three boxes. One, there's an inflation consequence of this tariff program. Two, there's a deficit consequence of a lot of these tax cuts. And three, this trade war could invite international retaliation. What we get is a global trade battle, something like we saw back in the 1930s. Does that worry you, or are you net still a believer that the pro-business style of this budget will drive markets higher?
So I think a lot of his vision really depends, the success of it depends on the execution and the sequencing of how they put these plans into place. So if they go through with the deregulation and slimming down the government, it could lift sentiment. If they put the tax cuts through, it could, make people feel a lot more confident about investing. But the tariffs and the immigration, which really is, based on two pillars of deporting people, illegal immigrants in the US, as well as tightening border control, will really impact not just inflation, but also long-term US growth potential. So it's really how the two marry up.
So let's briefly wrap up then. We at Sarasin are sitting still on our overweight equity call. We believe this is broadly a pro-business deregulatory budget, but of course there are risks for Europe and Asia. And that'll mean that we'll continue with our heavy focus on some of the national champions of the US, particularly the technology names. We'll remain to underweight Greater China just because of the pressure, until we know a little bit more of the pressure from those tariffs. We're overweight gold, that's our hedge, if you like, against a debasing of the US currency and the excessive borrowing that we're seeing in the US and around the world. And we'll remain underweight bonds for essentially similar reasons, that most of the Trump program does risk, in some way or other, a higher deficit. I hope that's helpful. I hope it gives you some idea of how you can map this enormously complicated electoral program into an underlying philosophy for your portfolio. And thank you, Subitha, for your time with us. Inspiring. Thank you again.